Good morning. We will pay attention on the theory of general ledger today. Assets are possessions of the business that will cause the inflow of money in the future. Assets are divided between non-current assets and current assets. Non-current assets will be used for a very long time and it will not change within the next 12 months. For example, land, building equipment, furniture, vehicles. Current assets changes all the time and there will be an increase or a decrease in inventory and debtors every time when we buy or sell goods, in the bank every time when you pay. So that is the current assets that changes regularly. Liabilities are claims from creditors because we owe them money, or from financial institutions because we borrowed money from them. We also divide the liabilities between non-current liabilities and current liabilities. Non-current liabilities we will pay back over a period longer than 12 months in the future, for example, loans and a mortgage loan, and a current liability will be paid back within 12 months, for example, creditors and bank overdraft. Equity is the interest of the owner in the business, so that is his two accounts is the capital account and the drawings account. You can also say equity is the amount that the owner can lose if this business goes insolvent, or it is the amount that the business owes the owner. Expenses reduce the profit of the business, so the owner will get less profit and therefore it will reduce equity. For example, salaries, electricity, stationery, advertising. Income increase the profit of the business so that the owner will get a bigger profit and the equity will increase. For example, rent income, sales, interest. It is very important to remember which accounts increase on the debit side and which increases on the credit side. Assets increase on the debit side. Expenses increase on the debit side. So it means the first letter of Alice and the last letter of Alice will increase on the debit side. So if you look at the word Alice, assets and expenses increases on the debit side. Liabilities, letter inside, income. Capital is the owner's accounts, equity will increase on the credit side. So it's important to have a word or a memory that you can remember exactly which accounts is increased on the debit side and which ones are increased on the credit side. If we look at the ledger account, the debit side is on the left-hand side of the T account, and the credit is on the right-hand side of the T account. In the general ledger, assets and expenses will increase on the debit side and will always have a debit balance. Liabilities, income, and capital will increase on the credit side and will always have a credit balance. The owner's two accounts is capital and drawings. Capital increases on the credit side because it increases owner's equity. The business owes the owner more money. Drawings is when the owner takes money or goods for its own use. That means he reduces the money that the owner will receive out of the business. Therefore, drawings will always increase on the debit side in the drawings account, but the effect is that this drawings will decrease owner's equity. The whole purpose of a business is to make a profit. So income that increases on the credit side will increase profits and the owner's equity will increase. Expenses that increase on the debit side will reduce the profits and the owner will get less profits, so the owner's equity will decrease. Any of these four accounts that affect owner's equity, that means capital, drawings, expenses, income. If we record an entry in any of the four on the debit side, it will reduce equity. If we record any entry in any one of these four on the credit side, it will increase equity.